Okay, good afternoon and welcome to this session of the London Financial Regulation Seminar, our first session this academic year, which the subject is addressing ESG risks in the EU banking framework. We are delighted to have with us as presenter Ms. Dorota Wojnar, who is the head of ESG Risk Units at the EBA, the European Banking Authority, and as discussant, Mr. Riccardo Sallustio, who is a partner in banking and finance practice at Advant NCTM in Milan. Before I give the floor to Dorota, let me just say a couple of words about the seminar itself and a couple of words about the presentation. So the London Financial Regulation Seminar is an inter-collegiate and interdisciplinary group of experts, which is actually led by the Center for Commercial Law Studies and our Institute of Banking and Finance, which is led by myself and Professor Rosa Lastra, the Sir John Lubbock Chair in Banking Law, and by my colleague sitting next to me, Dr. Daniele D'Alvia, who is a lecturer in Banking and Finance and who will be conducting the Q&A. First, a few words about our presenter, and I'm very grateful, especially knowing that she's fighting a cold in addition to working and addressing us in the seminar, so it's really appreciated. So Ms. Dorota Wojnar, she leads, as I said before, the ESG Risk Units at the EBA, the European Banking Authority, and in this position, she oversees the integration of this environmental, social, and governance risk into the prudential supervision of banks in the European Union. And she has great experience in a number of fields which are very relevant, both for our seminar and for the field of sustainable finance. She's an expert also in financial regulation, in risk management, and she has worked with obviously other authorities to ensure that ESG risks, which are fundamental and should never be underestimated, notwithstanding the current geopolitical climate, are adequately addressed within the EU banking system. I will introduce Mr. Riccardo Sallustio when he starts his discussion after the presentation, but I will just say a few words that the way that the prudential banking framework in the European Union incorporates the risk management, disclosure, and supervisory convergence with regard to ESG is fundamental for the future of banking, is fundamental for the future of sustainable finance, and is actually fundamental in the context of climate change related and broader ESG factors for the very future of the European Union, not just of our financial system. And we are very grateful that with her insights, which she's going to share in a presentation that she will display shortly, she can help us understand better what for sure is an changing and evolving regulatory landscape, and still, I should say, nascent regulatory landscape to incorporate ESG risk supervision in Europe, and perhaps in future to come to an agreement at the European level as well as international on the risk metrics that we should all use in order to provide harmonized and comparable treatment. With this, also I have to apologize that we have some unexpected and unintended background noise, and that is because we are in the midst of an induction at Queen Mary and we are not in our offices. So with that, I will put the microphone off and give the floor to Dorota, again, thanking her very much for being with us today.
Thank you very much for this very kind introduction, and it is my great pleasure indeed to be here. So thank you once more for the invitation. I'm just putting up my slides right now. I hope you can see them.
Yes, we can.
Starting from the beginning. So, as you said, my name is Dorota Wojnar. I'm with the European Banking Authority, where I'm leading the efforts related to incorporating ESG risks considerations across the framework for banks. But before I go into details about what we are doing about this topic at the EBA, I thought that it will be useful for you to get a little bit of background of how the system of regulations in the European Union works in general. So how the process more or less goes in putting together any finance-related regulation. And then I will say a few words about the broader spectrum of initiatives related to sustainable finance from the regulatory perspective in the EU. And then I will also give you a little bit more details about what we are doing at the EBA, as I mentioned. So first, as an introduction, and here you will get a little of a bit of the European jargon that we are using on a daily basis, and we sometimes don't even realize that people might not necessarily follow. So in the European Union, the regulatory framework is based on 3 levels of regulatory products. The level 1 regulation, as we call it, these are the EU regulations and EU directives. And these are regulations and directives that are adopted by the 3 co-legislators in the European Union. So it's quite a complicated process to actually put together a regulation or a directive, because it requires agreement between the European Commission, the European Parliament, and the European Council. European Council is basically the heads of member states. So this is quite a lot of parties around the table that need to come to an agreement to come up with the EU regulation or EU directive. And then the difference between the two is that EU regulations apply directly to whoever is the addressee of the regulation, whereas the directives have to be still transposed into a national legal framework. So they have to become a national law before they become actually binding. Then the level 2, and here comes the role of the EBA, but not only the EBA, because in the space of financial sector as a whole, there are 3 we call it sister agencies. This is the EBA, the ESMA, which is European Securities and Markets Authority, and EIOPA, which is an agency that is dealing with insurance and occupational pensions. So these 3 agencies are independent technical authorities that are contributing to, again, what we call in the European Union a single rule book, which means that a single harmonized regulatory framework for the member states of the European Union and the addressees of these regulations. All 3 agencies, including the EBA, we are providing what is called regulatory or implementation technical standards. These are then provided to co-legislators, which transform that into European legislations, or like the European legislation, which is basically delegated regulations. So the technical standards, once adopted, they become EU regulations and are directly applicable by the addressees. There is not much difference between regulatory or implementation technical standards. From the legal perspective, they work in a quite similar way. Just implementation technical standards are more technical. There's usually some templates in them or more technical aspects, whereas regulatory technical standards resemble a bit more what would normally be an EU regulation, even at the higher level. So these technical standards can be provided by EBA, ESMA, or EIOPA in the space of financial sector. There's also other agencies that are active in other sectors. And then level 3, these are the guidelines. And here again, the EU agencies are sometimes required based on a specific mandate, or allowed based on own initiative, to provide guidelines to the participants of the financial sector. These guidelines are subject to what we call comply or explain process. And here, just to clarify that this is not, so if the addressee of the guidelines is a bank, then it's not the bank that can say whether or not it intends to comply with the guidelines. It's the competent authorities. And here again, a bit of a jargon, what we call competent authorities. These are the national supervisory authorities in each member state. And the European Central Bank, and in particular the part that is that has supervisory powers over the largest banks in the Eurozone. So in the member states of the European Union, those which adopted euro, the biggest banks from these countries are supervised directly by the European Central Bank. And so that's why we don't refer to national competent authorities, because not all of them are purely national. The ECB is also a competent authority in this sense. So these competent authorities declare whether or not and to what extent they will comply with the guidelines. And if, and in most cases they do, they declare that they will comply, then all the banks that are subject to supervision by these institutions have to adopt the provisions of the guidelines. So that's in a nutshell how the legal system in this particular context in European Union works. So if I will be using any of this jargon, then at least you will know what I want to say. Now moving on, and here my worst nightmare. No, it is moving. Okay, so now moving on to specific regulations related to sustainable finance. And here what I wanted to explain, which is I think quite important, is that there are two distinct objectives of what this regulatory framework is trying to achieve. And sometimes, and I think it's important to clarify this, because sometimes these two dimensions, these two different objectives are being mixed up a little bit. So on the one hand side, what the legislators are trying to do is to support the economy in transitioning towards sustainability. So here is all the initiatives related to making sure that the capital flows move towards transition towards sustainability. And then on the other hand, in the context of the financial sector, the regulation is trying to make sure that So we're trying to make sure that the financial system remains resilient against ESG risks. These two objectives, as I mentioned, are distinct objectives, and they require different actions, but they are interlinked. And on the one hand, transitioning towards sustainable economy requires a stable and robust financial system to be there because of the very high financing needs. So only a stable and effective financial system will be able to actually provide the very much needed financing for the transition. But then on the other hand, and more in the longer term perspective, the sustainable economy is a condition for the financial system to remain stable as well, because any strong disruptions in the real economy may, of course, then lead to disruptions in the financial system as well. So these two objectives are interlinked in the end, and these two objectives actually meet in the various initiatives related to transition plans. I will come back to that at the end of my presentation. But before I do so, with just a few words about the types of initiatives that are taken under the first and the second objective. So in the context of supporting transition to sustainable economy, what you will see there is above all the EU taxonomy, which is providing the standards and clear criteria of which economic activities can be considered as sustainable. Then on the basis of that, and in relation to that, there's initiatives related to specific standards and labels for financial products or services. And here Most prominently, we have the EU Green Bond Standard regulation, which is based on the EU taxonomy. Then there is a large spectrum of initiatives related to transparency to make sure that that the market is efficient from that perspective, and that the investors and market participants are able to take informed decisions based on the information that is available to them. The initiatives related to ESG rating providers also fall within the broader category of transparency, because here the objective is to make sure that any provider of ESG ratings would be required to disclose the methodology that they are using, so that the users of the ESG ratings would know exactly what these ratings represent. And then there's the whole spectrum of initiatives related to consumer protection, starting from a very general regulations or directives related to consumer protection in the broader spectrum of activities, not only finance, but then also specifically in the financial spectrum. The consumer protection amendments to existing directives basically state the obvious, that all the aspects related to the information that is provided by any product or service providers should be clear and fair and not misleading, that all these rules that have already existed since a long time also apply to any information related to sustainability matters. So in a sense, stating the obvious, but this clarification, I think, was necessary for this to be taken into account seriously. These initiatives, of course, cannot influence directly the decisions by the banks or investors on what to invest in. So that's sort of the challenge in this part of regulation, that we cannot tell banks or investors what to do and what to invest in, because they are independent in their decisions on how to do the business. But the idea is to create a favorable environment in which they will be able to take these decisions in an informed way. And then I will not stop longer on this, because actually at the EBA we are more focused on the second objective, and this will be the main focus during my presentation. So how to ensure resilience of the banking sector against ESG risks. And here we have a large spectrum of initiatives related to the capital framework, but also to aspects linked to risk management and supervision by banks on the one hand side, and competent authorities, so the supervisors, on the other hand. And I can just, I will come into a little bit more detail in a moment, but I will just mention here that in my view, this second objective is actually more difficult, and the complexity here is even larger than in the first one, because not only we need to have some sort of categorization about the sustainability of certain activities or entities, but also we need to link it to financial information, to specific vulnerabilities of companies and sectors or other types of entities. So this is, and we need to figure out how these the changing environment is going to affect the financial status of certain entities, which is leading to a quite high complexity. Moving on here, so the EBA. So what we are doing about all this? And as I mentioned, we are focusing on the second objective because this is in line with our mission to support financial stability in the EU. But we are taking a broad spectrum of initiatives, and you can see this graph on the slide. This is coming from our roadmap on sustainable finance that we published back in 2022. So if any of you were interested in the longer list of various activities that we took over the last years, you can take a look at that. I just want to mention here that in whatever we are doing, we need to make sure that we take a proportionate approach, because we are addressing the whole banking sector in the EU, which includes both the large institutions, but also in some cases very small institutions. So we need to do it in a proportionate way. We try to do it in a holistic way, try to incorporate ESG risks thinking within the existing elements of the prudential framework, which is already quite complicated, to be fair, rather than build yet another pillar, right? So that's our approach, to integrate rather to build something on the side. And here I will focus on perhaps the three most important areas in which we are active. That is the three main pillars of the banking regulation as designed by the Basel Committee in the Basel framework, which is of course also incorporated in the EU. And I will start here from the third one, because this is also sort of the order in which we took actions here at the EBA. So in the context of Pillar 3, which is basically disclosures and market discipline through disclosures, we provided templates, harmonized templates for the banks in the EU. So far, only large and listed banks, but the next step will be to enlarge this scope of application to also smaller banks in a proportionate way, of course. So that these banks, starting already from 2023, they have to disclose information about their ESG risks. Within that, the whole spectrum of ESG risks has to be disclosed in a qualitative way through the descriptions about how banks are managing these risks, how they set up their strategies, governance arrangements around it. And there is also a number of templates to provide quantitative information, although this information is now focused on climate risk and climate metrics. And without going into more details, due to time constraints in here, I'm only just providing a link in here, just to mention that all this information that we are collecting from banks based on their quantitative disclosures, we are making it available in the form of an interactive tool that is available freely on the EBA website. This is what we call the ESG dashboard. So you have some nice graphs and quite a lot of data available there. You can check how the climate risk presents itself at this stage in the European banks. So I encourage you to take a look at that in a spare moment if you're interested, and I think that you might find quite a lot of interesting information there. Now, maybe jumping quickly to Pillar 1. So Pillar 1 is sort of the basis for the prudential framework. This is the minimum capital and liquidity requirements framework. So this is really the core of the Basel framework. And here in this context, this is in the European Union. This part, Pillar 1, is provided pretty much through level 1 regulations and directives, right? So coming back to what I was presenting at the very beginning, so the highest level legislation that is provided directly by the co-legislators. So this is where Pillar 1 is reflected. But on top of that, the EBA is receiving like a number of mandates to provide more clarifications and more details about how to exactly understand these requirements and how to apply them. So in this context, we were also requested by the European Commission to review the framework to see how this framework already reflects ESG risks, to what extent, and is there something missing? Should it be amended in some way to make sure that ESG risks are reflected there in a proper way? And we delivered a report on that in 2023, where we provided a very comprehensive analysis of the framework and suggested a few targeted amendments where we thought that it was possible to do without the whole rethinking of the whole Basel framework. And these suggestions were actually already incorporated in these level 1 regulation and directive. So this is the core of the banking framework in general, not only on ESG, like this is the banking framework in the EU. This is capital requirements regulation and capital requirements directive. And I can see right now that in this slide, I did not translate this acronym. So this is what means CRR and CRD on the slide. This is capital requirements regulation and capital requirements directive. Like I said, this is a banking framework in the EU. And here we already have at this stage some references to ESG risks. Most prominently, perhaps, we have definitions of what ESG risks are. So that's already a good starting point and good basis. So at least we know what we want to measure and what we want to address. It was less obvious as it may seem, in fact. We already have some requirements to incorporate ESG risk drivers in the stress testing programs in the context of internal ratings-based approach. We have a requirement that the collateral valuations, to the extent that they are recognized as the basis for the calculation of capital requirements, they have to reflect ESG risks as well. We have requirements related to disclosures and reporting about ESG risks. I already mentioned that earlier. And we have also a possibility to use macro-prudential measure, which is a systemic risk buffer, to address climate risk specifically. This has not been there before, but now member states, this is this macro-prudential measure can be applied individually by each member state, and now this can be used also to address climate risk. So I think that this was a good progress in reflecting these aspects in the framework for banks already. And then moving on to what we are doing at the EBA in the context of Pillar 2. And Pillar 2 is, to remind, is the aspects related to the risk management by banks and then the supervision of this risk management by the supervisors. This risk management and supervision can lead to capital measures as well. So in particular, the supervisors, as a result of their assessments, can impose, and they always do, they impose what we call Pillar 2 capital requirements or Pillar 2 add-ons, right? So these are additional capital requirements that come on top of Pillar 1 minimum requirements. And here in this context, the capital requirements directive, so what I call the level 1 legislation, the one that is adopted directly by co-legislators, is already imposing requirement on the banks to incorporate ESG risks in their internal risk management processes. They also have to reflect ESG risks in the internal governance arrangements, including remuneration policies. So this is quite strong requirement that exists already in the directive. The newest additions to this directive include also a requirement for all banks in the EU to have specific plans to address ESG risks. So despite this directive not calling it transition plans, but this is in fact part of what we would call exactly transition plans, and I will come back to that again later on to clarify it a bit better. But this requirement for all banks to have such a plan exists now in the directive. And then there is also a mandate for the EBA, so the requirement for the EBA to actually provide guidelines on how banks are supposed to manage, identify, measure, and manage ESG risks. So here we go. So that is our starting point, is this mandate. And we were working on providing these guidelines over the last years, 2 years, I think it took, more or less, until now. And these guidelines in their final form were published in January this year. They will become applicable by almost all banks from January 2026, some from next year, but only the smallest, what we call a small and non-complex institutions. So the smaller banks will have 1 more year, and these guidelines will become applicable from January 2027 for them. But here on this slide, what I wanted to also show is that these guidelines, which is sort of our flagship at the moment, right? These guidelines on ESG risk management. This is, I think it's fair to say, in this space, it's the most important regulatory product that we developed at the EBA, and the most comprehensive in that topic, but it is not coming in the void. So it is already following a sequential approach that has started long before. And already since 2021, so since quite a long time already, we have in the EU guidelines on loan origination and monitoring, which is already requiring the banks to incorporate assessment of environmental risks in their credit policies and processes. So they need to take that into account in the assessment of creditworthiness of their clients. And already these guidelines already required all banks to consider environmental risks in their collateral valuation processes, and also in the new product approval processes. Wherever sustainability aspects were considered in specific products, there were also specific requirements included in these guidelines already to make sure that this is reflected in a fair and clear way, and this would not be misleading to consumers. We also have already guidelines on internal governance and sound remuneration policies. As I already mentioned, this is also already reflecting aspects related to ESG risks. So all of this is already feeding into broader considerations about how to manage ESG risks. And again, these guidelines, the main focus for me right now, they are also not the very last step. There will be, we are also working right now on finalizing the last missing bit, guidelines on ESG scenario analysis. So you will see that in the guidelines that were published in January, this part on scenario analysis is not addressed yet, because this is exactly the last piece of a puzzle that will come sometime soon, hopefully before the end of this year. In general, we are planning to publish the final guidelines. And all of this that we are doing on the side of what banks should be doing in their risk management and governance processes, we also reflect that in the equivalent way also in the requirements for the supervisors on how to supervise the banks, so that this would also be reflected in supervisory review and evaluation processes, as well as, for example, supervisory stress testing processes. So these are also the aspects that we are working on right now. Moving on to how we are, so we have the mandate, and then what do we do with the mandate? Now we need to figure out how to specify the requirements. And I wanted to mention here that there are 4 general principles that we always have in mind when we are working on any of these regulatory products that I was mentioning. So first, in the context of ESG, like I said, and here I will stress that again, we are focusing on the second objective, which means the supporting the safety and soundness of institutions and their resilience against ESG risks, rather than supporting moving the capital flows towards green on transition finance. This is not the main purpose of the guidelines that we are giving. It's the second objective that we are addressing in here. Then the second principle is, I also mentioned that already, is proportionality, and this is very important in everything that we are doing. And here, specifically in the context of addressing ESG risks, we take into account two aspects. First is the materiality of risks. This is the basis for proportionality as well. So all the solutions that we require banks or supervisors to implement should be based on the results of their assessment of materiality of these risks in their specific context that they are operating in. And then the second dimension is, of course, the size and complexity of the businesses that banks are undertaking, taking into account in particular the large spectrum of very small institutions existing in the EU, where it would not be reasonable to expect very sophisticated arrangements there. But nevertheless, even the small institutions are clearly not immune to ESG risks. So the arrangements and the tools and processes that they adopt need to capture the material risks properly, but also be suitable for the specific context, size and complexity of a given institution. Then the scope. And here I've been talking all the time about ESG risks, and this is what we refer to in all our products. This is what we have in our mandate. But to be completely honest, while we are trying to address the whole spectrum of ESG risks, is the E that is most in focus, given the progress of the developments and the research and the metrics and the data. It is much more reasonable at the moment to expect some solutions in the context of risk management for climate and environmental risk. It is much more difficult on the side of social and governance at this stage, and this is also reflected in our regulatory products. But here, what I wanted to stress is that it is not enough anymore to focus only on climate. And even though we might treat S&G aspects in, let's say, less stringent way at this stage, it is important to go beyond climate in the spectrum of environmental risks and try to cover all other elements of nature-related risks as well. And then the consistency, I can see my time is actually running out very fast, so I'll try to speed up, but I think that these were the most important things that I wanted to say, that we also try to keep consistency, not only within the various pieces of regulations in the EU in itself, but we are also trying to ensure and facilitate and contribute to the consistency of these solutions on the international stage with all the various initiatives that are taken globally on that matter. My next slides that I will only just flash them very quickly is about exactly the guidelines on ESG risk management, the sort of the flagship product that I mentioned that was published in January this year, where we provide guidelines for the banks on how to identify, how to measure, how to address these risks in there, and how to incorporate ESG considerations in their existing risk management frameworks and processes. And here in this context, we also provide specific requirements on how to develop these plans to address ESG risks that are now that they are required to deliver based on the Capital Requirements Directive. And here, the main message that we want to give is that there has to be one and comprehensive strategic planning process that will address all the various requirements that might exist from the perspective of the disclosures, transparency, sustainability disclosures in particular. So all these aspects related to strategy, risk management, due diligence, and reporting, they have to come together in the form of one comprehensive and consistent strategic plan that will also address ESG risks in the short, medium, and long term. And despite the name of transition plans, this is not only just about transition, it should address also transition and physical risks, mitigation, adaptation aspects. So this really should be something treated in a comprehensive way. And also one last thing to mention here, again, to say that from our perspective, we are dealing with the second objective of the sustainable finance framework, meaning the resilience against ESG risks. So we are not setting a requirement to set any specific form or level of the target. So there is in particular not a requirement to set a net zero target, but there is a requirement, of course, to have some kind of targets that are leading towards the direction of the transition towards a sustainable economy. And because of the time, I will stop in here, and I will be very happy to hear any comments or questions you may have.
Thank you very much, Dorota, for this very comprehensive presentation on addressing ESG risks in the EU banking framework from the perspective of the EBA. This was a real tour de force, so thank you very much. And now we will have first a comment by Mr. Riccardo Sallustio, and then we will have whatever time is left for Q&A. There is already a question in the chat. There can be other questions, and also people can just raise their hand. And Daniele D'Alvia, Dr. Daniele D'Alvia will take care of the Q&A. Let me just introduce very briefly Riccardo Sallustio, and the floor will be yours in a minute. Mr. Riccardo Sallustio is a partner in the banking and finance practice at Advant NCTM in Milan, and he's an expert in green and sustainable finance, among many other areas of expertise, which also include leverage finance, debt restructuring, private placements, real estate, and bond issues. He guides his clients on ESG and transition due diligence, as well as ensuring that green and sustainable finance products are aligned with the EU standards that we just heard about, as well as international standards and social and governance best practices. He also serves as adjunct professor of green and sustainable finance at Luis Guido Carli in Rome, and is a member of the European Association of Environmental and Resource Economy. So Riccardo, thank you very much for being with us today, and the floor is yours. We will again mute ourselves. Thank you.
Thank you, Rosa, and thank you, Daniele. And first of all, thank you, Dorota, for the very, very interesting presentation. I have a few considerations to make, and if I may, I will ask Dorota to comment on some of the aspects that she raised in her presentation. First of all, I mean, as you all know, the EBA's work is extremely complex in the current scenario, because obviously we have an increasing challenging environment, which is not only due to the rising temperatures, but also because of the current ESG backlash. And obviously, I mean, the way the Sustainable Finance Action Plan of the Commission, in which the roadmap of the EBA is actually connected, has received, let's say, some sort of derailment in the last few months, I would say in the last year or so. And as one journalist said, is as if the EU has sent a rocket to the moon, and halfway through told the rocket to go in a different direction. We don't know which is the direction we are going. Clearly, what we have seen is that banking regulators and the EBA, the ECB, as well as the Financial Stability Board at international level, have set very clearly the roadmap. And even though, as Dorota said, the guidelines that have been issued do not focus on capital flows, but mainly focus in the scope that she described on risk. Actually, they provide a very interesting roadmap for banks. And clearly, this is also thanks to the transition planning that banks are supposed to put into place, which is not just the preparation of a plan, but really it's about creating a framework of policies, of actions, of risk assessments, of tools that they need to apply. And this actually engages with not only the risk side, but also the financing they have to put in place. So overall, I mean, there are some obstacles, and these obstacles is going to be as a result of the reduction in scope of the CSRD and of the CSDD, is the unavailability of granular data. And so this is clearly one issue. And the other one, which is an issue that we know about, is the complexity of dealing with risks such as biodiversity. And unless there is a strong emphasis on sustainability reporting that address biodiversity loss, we may not have the relevant data, and the relevant data will not go through the banks and the regulator. We know that, as Dorota explained, we have minimum requirements on S&G. However, banks are still bound to look at these aspects, and they are definitely also included in the Pillar 3 ITS reporting. The problem really is that there is a legal uncertainty, and this legal uncertainty is something that regulators and supervisors are trying to deal with, as well as one of the critical issues, and we will see, I mean, was going to be the outcome of the discussions with the competent authorities in the member state, is clearly proportionality. Because at the end of the day, proportionality, while might not be in some cases in some banking regulations so critical, in this case, because of the nature of the risks, which can actually impact a small bank as well as a big bank. Let's think about a small bank with actually focusing on agricultural borrowers in a specific area. That one could be extremely critical, and given the level of lack of data, or in an event specific adaptation issues in a certain area. So we are really dealing with a number of different obstacles that eventually, especially the competent authorities, will have to deal with. And the one other area I would like to mention is the risk of ineffective client engagement. Client engagement is something which is extremely important and has been addressed in the ESG guidelines prepared by EBA. And so it's so important that eventually within the transition plans, banks identify what's the best approach to engage client. And even though, I mean, as we said, there's not a focus on capital flows, the reality is try to understand exactly the scope of the risks, both for the physical and the transition side. So eventually, what actually this leads to is the fact that if we have less data, we're probably going to have more so-called proxy data, so data which actually are obtained by considering data, for example, that relate to bigger companies which are available, and as a result of that, whether it is the ESG rating agencies or the bank themselves will actually try to establish whether, to what an extent, these data actually apply to, for example, SMEs. So we are going to work, and the use of granular data would be eventually an issue. At the same time, we are seeing consumer protections being somehow, I would say, potentially halted. I mean, what happened with the Green Claims Directive in June, that the EU Commission announced that it would withdraw it. As far as I know, the withdrawal has not occurred yet, but obviously this is an area which needs to be seen. So the last area I wanted to mention is the fact that there is a if you have less data, if you have in an event an ESG backlash, this generally creates higher risk of climate change litigation and of deforestation litigation, which because of the EU deforestation regulation will come into force in January 26. And this will be an increasing area of potential litigation. So where we stand is really a situation where we have a lot of relevant and critical risks and a lot of work that eventually the supervisors and the regulators will have to do. I just have two questions for Dorota. And the first one is about, let's say, the status of governing products with and the product oversight and the governance. And I was wondering, in this respect, also consider the loan originator and monitoring policies. I mean, they've been there for quite a while. Whether there are any plans to address product oversight and greenwashing also for commercial banks or for commercial borrowers. And considering also the fact that if the VSME standard will be applied, we're going to be needing a number of data and a lot of information in addition to what the SME would provide. So due diligence on greenwashing will be definitely an area. So first questions I have was whether any plans on greenwashing for commercial bank. And the other one is about a comment I wanted to ask Dorota about the legal risk. So clearly in a situation where we have less data, we have the engagement with clients becomes more complex because of the backlash. Getting information, convincing clients is not going to be easy. So this actually has an impact in terms, because actually this becomes an operational risk and a legal risk. So how do you see the legal risks of the banks in this scenario? Thank you, and the floor is yours, Dorota.
Thank you very much, Riccardo, for these very insightful comments. And there's quite a lot of topics that you touched upon. But responding first to your questions, indeed, so on the governance and product oversight, and you're absolutely right that there are quite significant concerns about possibility of greenwashing, and this is something that we also have at heart in monitoring. And what we see is actually increasing trends in reports on I wouldn't say greenwashing, but potential cases where accusations of potential greenwashing might come up. So there is more scrutiny from the side of the public, of certain NGOs to track the activities of banks in particular, and report any practices that might be considered as unfair or leading to greenwashing. So we're also trying to address that, both from the perspective of actually protecting the consumers or protecting the users of the products, but also protecting the banks from the risks of greenwashing for them that might lead to litigation processes. So in fact, the first question and the second that are quite linked to each other. So I try to address them both in a sense at once. So on the side of consumers specifically, because this is the most, let's say, vulnerable parts of the users of the financial products, we are working on the update of the guidelines on guidelines on governance and product oversight. Oh, now I got the title right, I think, which is exactly aimed at pointing out that in the process of developing and offering and using the products that are linked to any types of sustainability features. There have to be certain standards that need to be met, both on the side of information for the consumers, meeting the appropriateness of specific products for the consumers, and so on. So this is what we are trying to do on this front on our side. But then there is a much broader spectrum of other regulations that already exist that protect not only the individual consumers, but also the broader spectrum of users of financial products, including what I mentioned, the various directives and guidelines that are there on the unfair commercial practices, the MiFID, all the specific products regulation like mortgage credit directive. There's a few more examples that I could name there, but there's also requirements already included in the context of internal governance requirements for banks, also in the context of the product management, product development and management, that these aspects have to be properly reflected. So we are trying to address this issue from various angles in a hopefully quite a comprehensive way. But then the legal risks, you are absolutely right. They are also on the rise, and this is something that is worth monitoring a little bit closer, because we see that even though maybe up till now there have not been as many litigation cases, the frequency of these cases is increasing. So in this sense, there is an increasing legal risk. So banks have to be mindful of what they are doing and what they are saying, and making sure that is too much. And here you also mentioned the potential legal risk in the context of the let's say changing environment. So I also want to loop into that aspect. And when you said that in EU there's now the rocket that is requested to go in a different direction, I'm glad that you didn't say that the rocket has to come back right now, because this is not really the case, luckily. So here in this context, what I wanted to stress is that yes, there are efforts to simplify the framework in the EU, and I think it's a very good initiative to try to simplify some things that got perhaps a little bit out of hand. And if you look at the current request for sustainability reporting, it is massive. So I think that the idea to actually simplify it a bit is a good idea, right? Then of course the devil is in the details, how this is exactly done, which part of this information is the one that is crucial, which one is the one that is less crucial. This is something that is of course debatable, and this debate is going on as we speak. But I think the intention to simplify this is important, also from this perspective of what your concern was, that the more information we request, the more focus is on quantity and not on quality. And I think that there is really a need to become a little bit more focused and ask for a smaller spectrum, let's say, of data and information, but make sure that the quality of this information is good enough that it can be the basis for decision-making, whatever decision-making processes we are talking about. So this is also something that is going towards decreasing the legal risk, not only for the banks, but also for those entities that are required to disclose this information. These are corporate entities that are required to disclose, right? So they also face certain legal risks. And the more they say, the more they might be accused of saying something wrong. So they need to make sure that they get that information right. And it's not always so easy. So also from that perspective, I think the quality of information is the key aspect here. I will stop here, I think, because we are really running out of time.
Thank you very much. Yes, exactly. I was here, I was hearing, I think it's very interesting. For the sake of time, maybe just because we had one question from the audience, if you can take maybe very, very briefly. So I report the question that is how sustainable economy can support increasing resilience of poor and vulnerable groups of population. If you have few words and then we can wrap up. Thank you very much.
Yes, sure. Thank you very much. Thank you very much for this question. I will just note that that this question goes a little bit beyond of what the sustainable finance regulation is about, and in particular, a little much beyond what the EBA is able to do, unfortunately. But I will nevertheless say that that this is part of what we would call a sustainable and just transition. So this is, I think, within the considerations about how to lead this transition in a way that it does not harm those that are already vulnerable. And from the perspective of finance, I think that there's an increasing trend right now to focus not only on the mitigation of risk, which has been so far the focus, but also there is more and more thinking and more initiatives related to adaptation to the changing climate. And this is, I think, the part of activities that is particularly relevant from the perspective exactly of protecting the poor and vulnerable groups of population. So I hope that this will be even more in the focus in the coming months and years.
Thank you very much. I think we need to close the event, but I think it was very insightful, and I thank you for coming and also everyone for attending. Thank you, and see you soon.
Thank you very much for the invitation.
Thanks.